Wall Street closes lower in a volatile session as the year-end rally loses steam. Dow slips over 400 points while the Nasdaq and S&P 500 correct about 1%. Asian markets open largely lower on a weak Q coming in from the Wall Street and declining industrial profits in China. The gift Nifty is also suggesting a lower start for the Indian markets. Crude prices rise by about 1%, with Brent crude around $74 a barrel as U.S. inventories decline. Gold prices, meanwhile, dip marginally in the thin holiday trade. The RBI Financial Stability Report expects asset quality to deteriorate marginally in the next financial year, even in its baseline stress test scenario. Also warns about a sharp rise in retail write-offs, especially private banks, which could be masking bad asset quality. Hello, good morning. You've tuned into CNBC TV 18. You're watching Power Breakfast, and I'm Vinny Motiwala. Let's look at the markets, what they are doing, because the cues from the US markets weren't exciting, but Asian markets also nothing much of an excitement that is coming in on the opening front. Any of the indices that you're looking at it, most of them are trading in the red. Look at the Taiwan index, that's down almost 0.8% in trade. We have Hang Seng, that's trading with mild positive as of now, 46 points up, that is 0.2% of uptick there. But other than that, whether you look at the ASX 200, Nikkei or the Shanghai, all of them are trading in the red, especially Nikkei is down almost 1%. The China's data that came in as well, that also is something that missed the expectation. So we're seeing some bit of a pressure coming in on that front as well. And as of now, the Nifty implied open not indicating a positive start for the Indian markets, 160 points down. So surely that's a sharp downfall that we're expecting. And yesterday also the markets couldn't sustain in the positive or the green side. And then we saw a fall coming in. So today also we are expecting a bit of a red start coming in for the Indian markets. 162 points decline as of now indicated from the Nifty implied open. So keep an eye on that. But yes, look at the Wall Street also and what that did, because Wall Street ended Monday's trading session quite lower. Dow was down almost 400 points. S&P 500 corrected almost 1% and ended the day with a decline of that percent in the red. Tech-heavy Nasdaq also shed almost 235 points at the close. Now, all these major averages are heading into the year-end just shy of record levels, with S&P 500 and Dow up 24% and 13% respectively. And this is on track for the best year that they've seen since 2021. The Nasdaq also has gained almost 30% in 2024 and is on pace for its longest quarterly winning streak the one has seen since 2021. And staying with the Wall Street, let's listen in to what the former Fed Vice Chair Roger Ferguson had to say, and speaking about the expectations that he's expecting from the upcoming Trump administration, the decisions that are likely to take place and that could impact the U.S. economy. Listen in to his thoughts.
There will continue to be, tax cuts. I don't think they'll manage to cut government revenue as much as they want or government expenditures as much as they like. And so I do think their policies are likely to be more towards deficit spending for sure, which could feed into rapid growth, but it could also feed into greater inflation. So I think the only thing to expect right now is a little bit of wait and see. What an expectation, though, are probably slightly higher inflationary pressures because of deficit spending likely to continue.
Okay, that's all the global overnight action that we've seen coming in. But how are all these cues going to be impacting our Indian markets? We will go across to our research team who is standing by to tell you what the trade setup is looking like and what are the important stocks that we're keeping on our radar this morning. Good morning, Vivek, as well as Urmaz. And Vivek, let me start with you first. All these cues that we saw coming in, nothing exciting. What is this trade setup looking like today for the Indian markets?
Well, good morning, Vinny. It's the last trading day as far as calendar year 2024 is concerned. We're going into the last day or the last trading session of this particular year. What is it that we're looking forward to? Slightly muted cues, like you mentioned, all of the US indices closed in the red, but off the session low. So there is some slight minor positive takeaway from, but nothing taking away from the fact that 2024 has been a very strong year for equity markets, especially as far as US equities are concerned. Now, yesterday, an interesting trend, natural gas prices across USA surged almost 20%. This was on the back of a higher or a much stronger than anticipated winter as far as the month of January is concerned. Crude oil prices inched up slightly. Brent now trading near the $74.50 a barrel mark. Now, coming to the Indian markets, yesterday, very volatile trading session. The first couple of hours, you actually saw quite a bit of strength. The Nifty Bank at one point of time was up almost 1.4%, but then saw a very steep sell-off. Nifty Bank cooling off over 2% from the day's low. Most of the indices traded in the red. The only index that managed to marginally outperform was the mid-cap index, and on the back of that, the mid-cap index saw significant outperformance, especially against the benchmark indices that were seeing quite a bit of sell-off. There was also a bit of rebalancing, especially as far as the CPSE pack was concerned. So volumes over there, delivery volumes there were quite strong as well. Now, going into today, remember, market rate yesterday was in favor of declines. FI selling continued even, in what essentially a very thinly traded week as far as volumes are concerned. Asian markets, GIFT Nifty, all indicating a subdued start for our own markets today.
Okay, indicating a substitute start for our own markets today, but important stocks that you should be keeping on your radar this morning. Let me start with Mazgaon Dock. Now, the company has signed a contract with the Ministry of Defense, which is valued at around 1,990 crore rupees. This is mainly for construction of independent AIP plugged-based technology developed by the Defense Research and Defense Organization. So that is something that we are keeping an eye out on. Moving on, we have Ease My Trip that will be in focus. Now, sources say, CNBC sources say that co-founder Nishant Pitti is set to sell the remaining 14.21% stake for 780 crore rupees today. That's a one to watch out for. We have seen Nishant Pitti selling and reducing his stake in the company for a while now. Let's move on to Hindalco because that is also in focus. Now, the company has been allocated the Meenakshi coal mine in Odisha. The allocation has was formalized through vesting order, which was issued by the Ministry of Coal. Shriram Properties is the next stock that you should be keeping on your radar. They've announced a strategic sale of 3.9-acre land in Chennai, so keep an eye on that. RVNL, they bagged an order of around 137 crores sent from the Central Railway contract, and this is something important coming in there. Lupin, they've acquired a drug from Eli Lilly, which is a type 1 diabetes and type 2 diabetes drug that is homosulin so this is adding to the diabetes portfolio, so keep an eye out on that one. Plus, one of their litigations with Teva and another company in the US that was going on. Now, there's a delay, Amneal. So there was a bit of a delay that is coming in on that front, and that would lead to a positive move coming in for Lupin. So keep an eye out on that stock. Okay, that's the stock to watch out for in trade. But let's move on and go across to Hormaz, who's standing by to tell us which are the important FNOQs in today's trading session. Good morning, Hormaz.
Morning, Vinny, and nothing exciting as you just mentioned, right? Final trading day, you end the year usually on a high, but the GIFT Nifty is indicating anything but that. As of now, another gap down start that is likely for the Sensex and the Nifty. Short positions were seen both on the Nifty and the Nifty Bank in yesterday's trading session, and the index breaking below key support levels at 23,700 was that level to watch out for. It's closed below that, so now downsides open up further, and FIIs, the ones that are still around, continue to remain net sellers in the cash market. They were net sellers in the index futures as well in yesterday's trading session, and the net long exposure now is down to 14.3% as of closing during yesterday's trading session. Even the clients added 2.32 lakh contracts in yesterday's trade. Now the short exposure now 1.97 lakh contract short now are the FIIs as we speak. Now, when it comes to the options data, there has been significant call writing that is seen at higher levels, be it 23,800 or 24,000. So now what was earlier a support has now become a barrier for the index to cross on the upside. And as I mentioned, the downside levels have opened up is evident from the fact that there was some writing seen in the 23,200 and the 23,300 put options as well. So those are the levels to watch out for going into today's trade. The immediate support, of course, comes in around 23,550 and 23,800, of course, because of the call as per the options data. That becomes the first barrier on the upside that the Nifty has to cross. And in terms of stocks, there are no stocks in the FNO band today, but keep an eye out on Adani Enterprises. The stock was in the news all through yesterday's trade, and fresh long positions seen in that stock as well. So keep an eye out on Adani Enterprises, but downside levels, the one to watch for the Nifty.
Thank you so much for that, Hormaz. But on that note, we're going to slip into a very short break. Up next, we have Reserve Bank, which has released its financial stability report. We'll get you the highlights of that report on the other side. Welcome back to Power Breakfast on CNBC TV 18. Let's move on. The RBI has released a financial statement rise in bad loans and warned about the sharp increase that one is seeing in terms of write-offs at private banks. More from the central bank's recent stress test.
Gross NPAs at 1.2% are stable so far. The bad loans in the unsecured sector unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail 1 and 180 days, more than doubled in just 6 months, rising to 4.3%. Borrower indebtedness is also climbing. RBI says nearly 6% of borrowers compared to just 3.6% 3 years ago, and loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per this stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
Thank you so much for that update there, Ritu. But let's move on. And as equity markets look ahead into 2025, Survi gets us the 5 key factors the market will be looking out for as we move into the new year.
From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on 3 key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts. But Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex, as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year. Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity, and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
Thanks so much for that, Surbi. But on that note, we're going to slip into a very short break. But after the break, we'll get you what's happening in the world of commodities with Manisha Gupta. Welcome back to Power Breakfast on CNBC TV 18. But it's time to go across to Manisha Gupta, who's standing by to tell us what's going to be happening and what's happening in the world of commodities on the last working day of 2024. Manisha.
Vinny, thank you for that. And, even if it is the last working day, we've still seen some bigger moves coming in for commodities. I mean, we do understand that this is on the back of lower volumes. But look at the crude oil prices, and it was a percentage higher overnight. We're looking at prices trading at a 5-week highs now, and the prices have gained by 5% in the past month as well. Well, the markets are reacting to decline in U.S. inventories. There is colder weather in U.S. and Europe, and forecast of that continuing for the next week and 10 days as well. And then there are hopes of economic stimulus coming in from China. So markets clearly are taking support from that. Not the same case when you look at some of these metal prices, because silver declined 1.5% overnight. It's now trading at a 3-month low, and silver prices now has slipped below $29 an ounce as well. The hawkish U.S. Fed and uncertain industrial demand outlook seems to be weighing here. And then there is pressure also continuing in case of copper. That also fell 0.5% overnight. Copper is now trading at a 3-month lows. The China manufacturing PMI data that came in today has continued to decline. And the markets now are waiting for Chinese details on stimulus measures. That is still awaited. So even as copper prices have gained up by 5% in this year, they're still down 30% from the kind of highs that we saw in the month of May in 2024. So, well, yes, even as it's the last day of the year, we still have a big moves coming in for many of these commodities.
Absolutely, Manisha. Thank you so much for that. But with that, we're absolutely out of time on this edition of Power Breakfast. Thanks so much for tuning in. Up next, Bazaar Morning Call.